In 2008, an American family walked into a big box store and bought a television for less than the cost of a weekend getaway. Flat screen. High definition. It's cheaper than it had any right to be. They felt like they had one. What they didn't see was the factory in Guangdong operating on razor-thin margins. The local government quietly rolling over debt to keep production alive. The bank loan that would never be repaid at full value. They saw a bargain. The system saw survival. And that's the trap. Because when everything's too cheap, someone is bleeding. Right now, the world is watching China with a mix of fear and dependence. Its exports are flooding global markets again. Electric vehicles undercutting competitors. Solar panels priced so low, they're reshaping entire energy strategies. Steel, batteries, consumer electronics, all cheaper than rivals can match. Consumers cheer, politicians complain, competitors panic. But beneath the discounts is a structural problem that isn't about trade wars or tariffs. It's about math, and the math doesn't work. To understand why this matters now, you have to look at where China stands today. After decades of double-digit growth, the world's second-largest economy is slowing. Property developers have defaulted. Local governments are carrying hidden liabilities. Youth unemployment has surged. Domestic demand is weak. Factories, however, are not slowing down. They're producing more. This is not a coincidence. It's a policy choice. When China joined the World Trade Organization in 2001, it plugged into the global consumer engine. Low wages, massive infrastructure investment, and coordinated industrial policy turned it into the world's workshop. The model was simple. Build capacity, export aggressively, reinvest profits, repeat. For 20 years it worked. Exports grew, urban incomes rose, hundreds of millions were lifted into the middle class. Cities expanded at a speed that felt almost fictional. But the model depended on two assumptions. First, that the world would keep buying. Second, that domestic growth, especially through real estate, would absorb excess capacity when exports slowed. That second pillar cracked. Developers like Evergrande borrowed heavily, pre-sold apartments, and built entire districts on the assumption that property prices would keep rising. Local governments relied on land sales to fund budgets. Banks financed the cycle. Households poured savings into apartments that sometimes never finished construction. When property stalled, the shock wasn't just financial. It hit confidence. And confidence is oxygen for consumption, so households pulled back. Spending slowed. Investment hesitated. But factories were already built, supply chains already optimized, workers already trained, industrial loans already issued. You can't just switch that off. Instead, production kept climbing. Take electric vehicles. Chinese manufacturers, backed by state support and cheap financing, built capacity far beyond domestic demand. Companies like BYD expanded rapidly. Prices dropped. Inventory piled up. To clear that inventory, exports surged. The same story repeats in solar panels, in batteries, in steel. Overcapacity pushes prices down globally. Foreign competitors struggle to match the pricing. Governments respond with tariffs. Headlines talk about trade tensions, but tariffs don't fix the underlying arithmetic. Here's the uncomfortable mechanism. When domestic demand is weak and companies can't raise prices at home, they cut margins and push goods abroad. If financing is cheap and losses are absorbed indirectly through state banks, local subsidies, or deferred debt, firms can survive longer than pure market logic would allow. From the outside, it looks like dominance. From the inside, it's compression. Margins shrink, debt accumulates, return on capital declines, and yet output rises. It's a strange equilibrium. Factories operate not because profits are strong, but because stopping would be worse. Shutting down would mean layoffs. Layoffs mean social instability. Instability is unacceptable. So the system tolerates low profitability to preserve employment. This is where irony creeps in. The rest of the world complains that China is too competitive, that its goods are too cheap, that it's unfair. But being too cheap is not a sign of health. It's often a sign of desperation. Look at producer prices inside China. They've been in deflationary territory. That means companies are receiving less for what they sell, not because they're inefficient, because because supply exceeds demand. In a normal market economy, excess capacity leads to bankruptcies. Plants close, supply shrinks, prices stabilize. In China's model, closures are slower, losses are socialized quietly. Credit rolls over, output continues. This creates a global ripple. Cheap exports lower inflation abroad. Consumers benefit in the short term, central banks get breathing room. But domestic producers in other countries face pressure. Manufacturing bases shrink. Political backlash builds. It becomes a geopolitical issue. But strip away the politics, and the core question remains: can an economy survive on perpetual overproduction? Let's break down the financial plumbing. Local governments in China rely heavily on land sales for revenue. When property markets cool, that revenue drops. Yet they still need to fund infrastructure, social services, and stimulus measures. To bridge the gap, many created local government financing vehicles, essentially off-balance sheet entities that borrow from banks to fund projects. Debt piles up in shadows. Banks, many state-owned, extend credit because growth targets matter. Projects continue because employment matters. Factories receive support because industrial capacity is strategic. The result is a system where capital allocation is driven as much by stability as by profitability. Again, this worked during high-growth years. Rapid expansion masked inefficiencies. When growth slows, inefficiencies surface. Return on assets declines. Corporate debt ratios rise. Young workers struggle to find jobs that match their education. Consumer confidence wavers. And still, export numbers look strong. That's the trap. From abroad, strength. Consider this. If companies are selling at extremely low margins just to maintain cash flow, any external shock, tariffs, currency fluctuations, global recession hits harder. There's no cushion. Meanwhile, competitors in Europe and the United States respond with protectionist measures. They argue that heavily subsidized goods distort markets. Tariffs go up, trade barriers expand. China then faces a dilemma. If it slows production, unemployment rises. If it keeps exporting aggressively, trade tensions escalate. Neither option is clean. There's another layer. When prices fall too much, consumers delay purchases. If you expect tomorrow's car or solar panel to be cheaper than today's, you wait. That behavior reinforces deflation. Companies cut prices further to stimulate demand. Margins thin even more. Deflation is subtle. It doesn't feel dramatic like inflation, but it erodes profitability quietly. Japan experienced something similar after its asset bubble burst in the early 1990s. Decades of low growth, persistent deflation, and corporate caution followed. China is not Japan. The demographics, political structure, and global position differ. The arithmetic of excess capacity and debt has familiar echoes. Now step back. Why does this matter to someone outside China? Because global supply chains are interconnected. If Chinese firms collapse abruptly, commodity demand drops. Emerging markets that export raw materials feel the shock. If trade tensions intensify, prices for consumers rise elsewhere. If financial stress spreads through interconnected banks, global markets react. Cheap goods have been a hidden subsidy for global consumers for 2 decades. They've kept inflation lower than it might have been. They've shaped retail, technology, renewable energy adoption. But that subsidy depends on a system absorbing internal strain. Question is how long that strain can be absorbed. Public narratives often frame this as unstoppable dominance. Headlines highlight record export numbers, technological advances, market share gains. The quieter reality is margin compression, rising debt burdens, and fragile confidence. It's possible to be globally competitive and financially vulnerable at the same time. That's not a contradiction. It's a phase. So what happens next? One path is painful restructuring. Allow inefficient firms to fail. Consolidate industries. Accept higher unemployment temporarily. Rebalance toward domestic consumption. Strengthen social safety nets so households feel secure enough to spend. That path reduces overcapacity but carries short-term instability. Another path is continued export push. Lean into industrial policy. Seek new markets in developing regions. Deepen trade ties where possible. Manage debt gradually through controlled financial repression. That path preserves employment but prolongs imbalance. Neither path guarantees smooth outcomes. And here's the part most people miss. If goods are consistently priced below sustainable profit levels, someone eventually pays. It could be shareholders through dilution, banks through non-performing loans, taxpayers through bailouts, workers through wage stagnation, or foreign competitors through lost market share. There is no free lunch in macroeconomics. There is only deferred cost. China trap isn't that it makes things cheaply. It's that it may have built a machine that can teeth slow down without hurting itself. Factories are efficient. Infrastructure is vast. Supply chains are world-class. But when growth is driven by volume instead of value, the margin for error narrows. If global demand weakens, pressure intensifies. If trade barriers rise, options shrink. If domestic consumers don't regain confidence, rebalancing stalls. For now, containers keep leaving ports. Prices stay low. Consumers worldwide continue to benefit. It looks like resilience. Maybe it is. Maybe it's a system running faster to avoid confronting its own overcapacity. When everything is too cheap to survive, the real question isn't who wins the price war. It's who absorbs the losses. And whether the world is prepared for what happens if the answer changes.